Financial Accounting, Long-Term Assets, Chapter 9, Part 2 of 3. So we ended Part 1 of 3 with the idea that there are 3 depreciation methods and that we will be discussing 2. The third one is a little more advanced, and you will be talking about that if you're an accounting major in an upper-level accounting course. Let's start with straight line. It means the exact same amount of depreciation expense is recorded as an adjusting journal entry for each year of the asset's useful life. And again, remember, we studied this in Chapter 3 on adjusting journal entries. So essentially, you take the depreciable cost, and this is where you need to go back and remember the definitions that I suggested that you memorize. The depreciable cost is cost minus residual value. You divide it by the estimated useful life, and then the example of the forward depreciation. So it turns out to be 20% a year. That's 20% for 5 years is 100%. And we're going to take that $4,400 so that each year we record depreciation expense of $4,400, and accumulated depreciation expense is going to be building. And by the end of the 5th year, when you've recorded this 5th year's adjusting journal entry, the the depreciable cost will be shown in accumulated depreciation. So the initial cost of $24,000 will be listed as an asset, and the depreciable cost will have been fully depreciated, so you'll have $22,000 in accumulated depreciation. And when you look at the net of those two, you'll see the residual value of $2,000. I will show you that in what it looks like in numbers in a minute. Depreciation expense, $4,400. Accumulated depreciation, $4,400. Debits equal credits. And this is to record depreciation for the first year. And every year will be the same, unless you have a partial year, which might happen if you possibly sell or dispose of this asset. We will talk about that in Part 3 of 3. So accumulated depreciation is a contra account. Contra means against, so this is an asset account with a credit balance because it goes against the normal. And accumulated depreciation accounts are deducted from their fixed asset account. Now this is just an example I pulled out, but in this example, it is not the forklift, it's similar. We have equipment of $24,000. This is your asset right here. And then we're accumulating depreciation expense through this contra account, this contra asset account that has a credit balance. And the net of those two, when you subtract them out, in this example, is $16,000. So let's go back to Chapter 3 again. The adjusting journal entry for depreciation expense results in an increase to depreciation expense and an increase in accumulated depreciation. As a reminder, assets are not closed. They're permanent accounts. They're not closed at all, and so therefore, this depreciation that you're recording here continues to accumulate. I think you'll see this a little more clearly, as always, with homework. That's the whole purpose of homework, is instead of reading or listening to the narrative, it's understanding by doing. So here's our example with the forklift, the equipment, $24,000. The first year accumulated depreciation is recorded. The book value, or net, it's also called net, the net amount is $19,600, and this is considered the book amount because it's the amount on the books. Sorry, not very neat handwriting. It's the amount recorded on the books. It's not what it's worth. It's just the book value, the value on the books, showing the amount of accumulated depreciation over time. So we've got several definitions. One of them is depreciable cost. The other one is book value. Another one is the assets cost. It's important that you understand the transaction to record depreciation expense. There's a lot of memorization in this chapter, just to be able to understand a little bit further what happens when this is recorded. Let's go forward to the units of activity or production method, and it provides depreciation expense for each unit. So you have to find out how much you're going to depreciate per unit, whether it's the number of hours a machine has run, the number of miles driven, or the quantity produced. Sometimes it's called units of production or units of output. So in this example, management makes a decision between straight line or units of production. They have to figure out what the activity is going to be. And again, the numerator is depreciable cost. This is the formula. And the denominator is the total estimated units of activity. So depreciation expense is then recorded by taking the depreciation per unit found here with this formula, multiplying it times the units of activity for the period. So let's take the forklift, and let's say that it's assumed that this forklift will be running 10,000 hours. During the first year, if we assume there's 2,100 hours, we can calculate it as follows. The depreciation per hour is taking the 22,000 depreciable cost divided by 10,000 hours to come up with $2.22 per hour. And then we take this $2.22 per hour and we multiply it times the 2,100 hours that the machine operated in year one. And we come up with $4,620. So you can see, straight line gives you a nice, even, consistent amount, but the units of activity method depends upon the amount of use and what the activity is. In this case, again, it is machine hours, but it could very easily be miles or units of production. Depreciation expense is recorded with the D, E, and the A, D as the credit. This is our contra asset. This is our expense to match with revenue. Now, if we assume that each year we have inconsistent use of this forklift, we take each year, and the depreciation expense is depending upon the number of hours multiplied times $2.20 per hour. And so here's what it looks like. $4,620 in year one, $3,300 in year two, and so forth. And again, while it's good for a textbook to show that, yes, they used exactly 10,000 hours over 5 years, because this is an estimate, it's highly unlikely. Now, these charts depict depreciation expense per year. This one shows what happens to the book value, and note again, book value is declining. Do you remember what the calculation is for book value? If not, go back and review, because that's an important piece to memorize. Again, I advocate for flashcards. It worked in probably elementary school all the way through high school and college, and I see many successful students using them. And as I've said before, there's something about handwriting it as opposed to taking the flashcards that the book provides. So let's move forward. We've gone through our two different types of depreciation expense. Let's talk about the difference in repairs and improvements. Frequently, ordinary maintenance and repairs occur once a fixed asset's been acquired. So something breaks or needs to be fixed, and in that case, costs that benefit only the current period are considered to be revenue expenditures, and they're recorded as an expense. And in that case, it's going to be recorded as repair and maintenance expense. But if it improves an asset and it's going to last for a longer period of time, it's going to be considered an asset. So let's think about this as far as a revenue expenditure. Let's take a truck. If the truck has an oil change, that's an expense, that's an ordinary maintenance and repair. And it would be under maintenance expense. If the truck has an overhaul of a new engine or maybe new tires, that's going to be extending the life of the asset, In that case, it's going to be a capital expenditure and it's going to be considered an asset, and we'll increase the value of that asset or set up a new one. Depends on the company's strategy. And this is where you hear the term capitalize. And it's a little confusing for intro students because the term capital is used a lot, but it's considered to be a capital expenditure. Ordinary maintenance, for example, let's go back over it again. Revenue expenditures, increase repairs and maintenance. That's sort of your oil change. And here we go, $300 for a tune-up. The transaction would look like this. But if they add a hydraulic lift, it might be recorded this way to increase the delivery truck's cost and showing the cash output. And then, of course, this delivery truck's depreciation expense is going to be changed or modified because we now have another $5,500 to record over its estimated useful life. And it just depends on the company and the way that they choose straight line versus production method. And this is just an idea that you have to go through, a process you have to go through. It's for tax and for financial statements. Is this an asset that I've paid money for? Or is this a repair and maintenance type of expense that's just going to last me for a year or less? So here's the way we make the decisions. You spend money related to a fixed asset. If it only benefits the current period, debit repairs and maintenance expense. If it's assumed that it will benefit future periods, then you consider it to be an asset improvement and you will debit the fixed asset itself and revise depreciation. So this ends part 2 of 3, and my strongest suggestion is at this stage you ensure that you understand these 2 methods and of recording depreciation expense, and also that you understand the difference between a revenue expenditure and a capital expenditure.